What's going on, traders? Welcome back to my YouTube channel. In today's video, I'm going to be breaking down a trade that was taken on EURJPY, totaling to a plus 13 risk to reward ratio. I'm going to be showing you my analysis, my trade management, my entry, my exit, and then also giving you guys some tips that I wish I personally received when I first started trading. Because I've been in your guys' shoes where you're trading for a long period of time, but you just quite haven't reached that level of consistency and profitability to take you to that next level. So I hope it helps, and if you haven't subscribed to the channel yet, make sure you do so you don't miss any more content. And yeah, I hope you enjoyed the video, guys. Let's get straight into it.
When I'm talking to you, I don't know what to say, but I can call up a stranger and talk my whole life away. Milwaukee margaritas, I didn't know that was a thing. Carry me home, marry me now, I promise you everything. Chanel in every city, simply talk dirty. Whoa, whoa, filthy mouth, filthy lips, but my teeth purple. Oh, I know, Bible scriptures on your.
Okay, so this is the position taken on EURJPY. This is on a 2-minute time frame. Really simple analysis. As you can see, price has had a strong impulsive move to the upside, forming a new higher high within the market, breaking through all of these levels of resistance over here. Now, for those of you that know how I trade, I always look for that initial impulsive move to the upside, and then following that, I look for some kind of correction back to the downside before the continuation back to the upside. And that's exactly what took place here. We can see that price corrected back to the downside to retest previous levels of resistance to be used as support. Not only that, but if we used the Fibonacci retracement tool from our most previous swing low and we drag that to our swing high, you can see that we rejected the 50% level pretty perfectly, which is nice. And then we started to see a slowdown in momentum. Okay, if you take a look at the candles that are down here, you can see how low the momentum is in these candles. And what that's telling us as traders is that the momentum is soon going to shift from bearish to bullish. Okay, and we waited for that momentum to start kicking in, which it did around this level. I took the buy position, stops below the low, and as you can see, we're moving in nice profits right now. We've literally just broken through this level here. So I'm going to be trailing my stop loss to break even. I might wait for a little bit longer. I might wait for it to move to the upside like we're doing right now, just in case this level gets rejected. I'll move my stop loss to break even. And then in terms of take profit level, how did I get to this level over here being at a plus 13 risk to reward? Well, I just used previous historical price movements. Okay, so down here, we can measure the distance that buyers stepped into the market previously. And then we can drag this to this level here. And that is what I used as my measurement tool to give me an idea of where to take my profits on this trade, which is actually quite good, because if I zoom out just a little bit, you can see on my left-hand screen this strong level of resistance that we have over here. Now, what most people would do, or what some people would do, is they would actually target all the way at the top of that level of resistance. However, with myself, I tend to target just before, because from my previous experience, whenever I see price approach a level of resistance, as we get closer to the level, price begins to slow down, okay, because buyers are taking their profits and sellers are trying to enter the market. So rather than trying to stay in the trade for as long as possible, just trying to squeeze out a few extra risk to reward, a few extra percent, I prefer to just take my profits a little bit lower, just in case price was to reverse before this level of resistance. But anyway, we're moving good right now. I might look for a scaling position depending on how price moves. If we get a nice clean structure to take a second position, then I'll look to do so. But for now, I'm happy with the risk to reward. My stop loss is going to be trailed to break even, and I'll keep you guys updated on how this position moves for the rest of the trade. So I didn't move my stop loss to break even, which actually played in my favor. Now, the reason I didn't move my stop loss to break even, as you can see here, we didn't actually really get like a clean break of this level of resistance. As you can see, the last time where we were on the chart was here, and I said, well, once we get a clear break, that's when I'm going to move my stop loss to break even. And as you can see, we had this huge wick rejection. So I had an understanding that price might need to come back down to this level again before actually moving forward. So I didn't move my stop loss to break even, and as you can see, it actually played in my favor because we had to come back to this level of support one more time to potentially grab some more orders. And as you can see, once again, we've had a push to the upside. Now, once again, we haven't actually really had a clean break of this structure. So let's wait and see how this candle right here potentially closes. If we can continue to go towards the upside, then I will trail my stop loss to break even. But all in all, it's looking good. It can really be a struggle sometimes when price is in this kind of corrective phase to know when the correction is over and when that continuation is actually going to follow through and we're going to get that push to the upside from buyers. It can be difficult, and it's during this period where you're going to see losses, you're going to see break evens, and it's going to be an emotional roller coaster. But if you have an understanding that and a probability of certain things happening over the other, then you should be fine. But let's wait and see. To be honest, if this does just reject now, I probably will just trail my stop loss to break even, purely because the time now is around 2 p.m. in the afternoon, and I don't really want to be sat watching this trade too much. So I'll just rather it hit break even than a stop loss at this point. But in my opinion, I do believe we're going to break, and it's looking good. So once again, guys, I will keep you updated, and let's see if we can catch a nice risk to reward to close the day.
All she do is work, fuck Uber Eats and get high. Never will I fly in coach, babe. Never will I fly in coach, babe. Spend your summers on a road, babe. I'm a vocal coach for your throat, babe. My ears are sensitive. Tell me that it's mine. All I hear is yes, all I hear is yes, yes it is. My ears are sensitive. Tell me that it's mine. All I hear is yes, all I hear is yes.
So before we jump into the breakdown on EURJPY, I wanted to quickly talk to you guys about something very important. Now, this is coming from personal experience because at the end of the day, I've been in your guys' shoes before. I've been a trader who's wanting to become a profitable trader. And a lot of it dialed down to things I knew that I was doing, but I just didn't do it because of ego, because of wanting to just get somewhere. And it came down to a few things, and we'll talk about it, and they all kind of combine into one. But firstly, patience, right? When you open up into the world of trading, you see people making this money, you see the luxury lifestyle, you see everything that you're seeing online on social media, which doesn't help. And you see people are doing it quickly, okay? So it's forcing you to have no patience. It's forcing you to try and run before you can walk. And I remember when I first started trading, okay, from my personal experience, it took me like 2 years to get profitable, okay? And when I say profitable, I don't mean getting to making thousands and thousands on trades. I mean to just be consistent, to be making more than I was losing, okay? Whether it was just £10, £20, £50, £100, just to get to that level where it was like, okay, I'm in a good place now. I can actually start to scale. And the reason it took me longer than longer than it should have is mainly down to just patience. I was trying to get to a certain level very, very quickly. And what that meant I was doing was, over the course of the 2 years, there was things that I should have been doing, but I didn't do because I was just trying to get there quickly. So we'll talk about it. For example, journaling your trades. A lot of you are probably watching this right now and you don't even journal. You don't write down what you're doing. And I remember being that person. It was like, oh, I don't need to journal, it's fine. I'll just take a prop firm account and just try pass it. And oh, I journal in my head, blah, blah, blah. No. Let me be the one to tell you now, the sooner you start journaling, the better. Because during those 2 years where I was not journaling, if I had journaled, it would have just been so much quicker. I would have had all of this data to show me and to work on and to improve and refine and get better. And I don't just mean journaling your trades and the risk to reward ratio and the profit and just the basic things. I mean journaling like everything. There's certain things when you're journaling that you need to understand. And I'll tell you now, because I know for a fact now that profitable trading mainly comes from the mind, right? So when you're journaling, journal everything, not just everything to do with trading. Journal things like how many hours of sleep did you get, what you're eating, how you felt that day. Literally just write down everything that happened on that day, plus obviously the outcome of your trading. How did you feel before you entered the trade? Where were you when you took the trade? Who were you with? All of these minor or minuscule details, the little small 1% changes is what actually makes a difference. The things that aren't going to make a difference to you guys is changing strategies, okay? What I found out was that I trade better when I'm trading in an office space, an actual environment, okay? Not when I'm trading in the car or at work or in bed. I trade better when I'm in an environment, and that's the things I didn't use to journal. But when I started journaling, I figured that out. I figured out that after I've just gone for a night out and I tried to trade the next day, I wasn't in the right mindset. My trading was worse. And it's all of these little things that might actually be affecting your trading and affecting you becoming profitable, more so than the actual things that are happening on the chart. Another thing is, you need to understand what kind of trader you are, okay? Because I say it all the time, but there's multiple different ways to trade, but there's only one trading mindset, okay? You can be a profitable trader trading swing trading, being a day trader, but find out what type of trader you are. And the way you find that out is by deciding whether you are somebody who likes to have a higher win rate, or you're somebody who likes higher risk to reward trades. Now there's pros and cons to both. If you're someone who's like me, who is comfortable with taking more losses, but wants to catch big trades when they win, then you're going to be a trader like me. But if you're not comfortable with losing, if you're not comfortable losing trades, my style of trading is not going to be for you. And that's just the harsh reality of it. If losing trades causes you to revenge trade and spiral out of control and do things you shouldn't be doing, then you need to be trading a strategy that has a higher win rate. And those come from trading smaller risk to rewards, bigger stop losses and stuff like that. Both can be profitable long term. I just prefer my way because that's what I'm like as a person. I prefer when I win, I want to win big. I want it to be rewarding. But what comes with that is more losses. But I'm comfortable with the losses. The losses do not affect me whatsoever. So you have to pick and choose. You have to decide what kind of trader you are. And it's these small things, these small minor details that you might not even think about. And I'll go into detail in videos in the future on on these different types of things, but trading goes so far beyond the charts, okay? You develop your mind as a person, and that's what you have to realize. But yeah, that's just some tips for you guys, and we'll now go into EURJPY, and I'll show you the full breakdown of how I came to the analysis on the charts. Okay, so here we are back on the charts. This is EURJPY, the trade that was taken for a plus 13, just over a plus 13 risk to reward ratio. As you can see, it did smash through and go beyond our take profit, which is fine. Most of you, or some of you, are going to be thinking, why didn't you just put your take profit at this level of resistance? Well, it's a 13 risk to reward. You can't argue with that. For the sake of an extra 2 risk to reward, I would rather be safe. I would rather get out, because as you can see, we did start to reject. As soon as it hit my take profit level, we did start to reject, and I've seen it multiple times in the past where we have just rejected before we've reached the level of resistance. And sometimes it's better to just get out a little bit earlier rather than trying to hold it through. Or sometimes I do, but I will just trail my stop loss aggressively just in case we do pull back. So there's a couple approaches to do it. But the main reason to jump on now is because I wanted to go through the fundamentals with you guys, the basics. In any industry that you're in, the basics and the fundamentals, you always have to go back to them. You always have to look at them, because they are the most important part. They're the easiest to understand, but they are the most important aspect when it comes to trading. So I'm actually going to jump up to the 1 hour time frame, because I want to talk to you about, well, what actually led me to get into this trade. What was the build up? What was the analysis beforehand that made me want to start looking for buy positions? Because that's the first thing you do. That's the first thing you should be doing, is when you're coming onto the charts, you need to first establish whether price is bullish or bearish. Are we uptrending? Are we downtrending? Who is in control of the markets? That's going to first of all give you that confluence and that probability for the trade to be positive, okay? If you're looking at the chart and you're analyzing the chart and you can't really work out if price is bullish or bearish, well, that's a clear indication that you shouldn't actually be trading that pair. Don't try and force analysis or force some kind of trend line or something to make it look like it's bullish or make it look like it's bearish, because then you're just forcing it. It needs to be obvious, okay? It needs to be very, very clear whether price is bullish or bearish, and that's the first step. And that's one of the reasons as well why I trade more than one currency pair. Because imagine if you're just trading one currency pair and that pair that you're analyzing is not looking good. There's no real structure. There's no real direction. But because you're only trading that one currency pair, you're going to be forced to try and find some analysis, because you feel like you're missing out on opportunities and you have FOMO because other people are trading. But that's just going to lead to negative results. And that's why I encourage multiple different currency pairs, so that if one isn't appealing, you can always go on to the next one and find that nice looking piece of analysis to really give you that confidence boost and that probability for your trade. But anyway, going back to the basics, the first thing you obviously always want to do is look at the market structure, okay? That's simple, okay? Is price uptrending or downtrending? Higher highs, higher lows, you know, all that stuff, lower lows, all of that. The next thing you need to look at, and that's what we're going to talk about, is the phases of the market. And I've mentioned this before in previous videos, maybe a while back, but it's always important, and I need to express this to you guys, because it's one of the most important things when it comes to trading. You need to have an understanding of not only the direction, but who's actually in control of this market right now. What is the story that price is telling me? And what I mean by phases, okay, there's two phases that the market can be in. We have an impulsive phase and we have a corrective phase. How do you identify the both without just having to just look at it and observe it? Well, an impulsive phase within the market essentially is when price moves with a lot of momentum in one direction in a short amount of time, okay? And a correction is the opposite, okay? It moves with small amounts of momentum in a shorter or a longer period of time, okay? And what that's telling us is that the people who are in this impulsive phase, there's a lot of momentum and they're in control of the market, and the corrective phase, wherever that's moving, that direction is clearly not in control of the market. And then that lines us up nicely for the continuation on the original impulse. I hope that makes sense. So really, really simple. I've mentioned it before, but the 3 stages: impulsive, corrective, continuation. Impulse, correction, continuation. Okay, it's as simple as that. And that's exactly what happened, right? You can see here in a real live example, this is what I saw. We had this strong impulsive move to the upside. Look at the candlesticks, okay? That's how you can really identify it. Strong bullish candlesticks in a short amount of time, covering a large amount of distance, okay? A large amount of volume within the market. Clearly telling us that buyers are in control of this market. And then following on from that, we had the correction, okay? Smaller candles, smaller bearish candles over a longer period of time, covering a much shorter amount of distance, okay? Short amount of time, large distance. Long amount of time, small distance. I almost confused myself there, okay? And then that lined us up nicely, or lined the price up nicely for then the continuation, okay? Once again, buyers stepping into the market. And that's exactly the reason for why we took this trade over here, because we had this correction to the downside, and then we were just trying to get in on the continuation after this correction had been finished, okay? But what does this actually mean? Because when you're looking at trading and you're analyzing the charts, you have to have at least a basic understanding of what all of this actually means, right? It's not random. This is price movement. Something is happening within the world to cause this to happen, okay? It's not random. It's happening for a reason. So we have to understand everything that's going on to a certain extent. For example, chart patterns, head and shoulders, isn't just a head and shoulders. It's price action moving from bearish market structure to bullish market structure. You know, a falling wedge is just the momentum slowing down from bearish market structure. The impulses are getting smaller and smaller, indicating a decline of momentum from sellers, which is a probable move for buyers to step into the market. Okay, you have to have an understanding of what's actually going on, rather than just identifying what it is. You need to have a understanding of why it's happening. So all this is telling us is that when buyers are stepping into the market, they're stepping into the market with a lot of force, okay? A lot of momentum, a lot of orders pumping into the market to drive price up, okay? And then once these buyers close their positions, they take their profits at the top here, for example. This allows sellers to now enter the market, okay? And this gives the sellers an opportunity to prove themselves, or to prove to us as traders if they are active within the market. Okay, and if we want to be buying the market, we do not want to see sellers active. So this gives us the opportunity to see that, well, we can see sellers aren't active within this market, and that gives us the opportunity to take the buy position, so on and so forth. Okay, if we want to be buying, we want to see inactivity from sellers. If we want to be selling, we want to see inactivity from buyers. And this is happening all over the place, okay? And it really just gives us that indication, to give us that probability that we are actually on the right side of the market. But that's just one confluence, right, that led me to kind of get into this trade. And I want you guys to take a minute, look at my screen right now, and tell me if you see any chart patterns on my screen. Okay, I mentioned one of them, so just say it out loud. Tell me what chart pattern you see. Well, an inverse head and shoulders pattern, okay? This is a bullish reversal pattern as well. So we can see that we have the left shoulder over here. We have the head down here. And we've got the right shoulder over here. Okay, this is a bullish reversal pattern telling us that price is moving from bearish market structure to bullish market structure. Look at the phases of the market when price was moving to the downside. Okay, exactly what I was just talking about. Strong bearish impulsive move to the downside. Look at the size of those bearish candles. Sellers are active within the market. And then look what happens here. We pull back in this corrective form where the price is very choppy. The buying candles aren't as big as the previous bearish ones. We're moving to the upside, and then following that, we get a continuation to the downside from sellers, okay? And it just completely switched on us. Buyers then stepped into the market and we did the complete opposite. Okay, we then corrected to the downside, so on and so forth. But yeah, inverse head and shoulders pattern. Now, where's the neckline? So the neckline doesn't always have to be straight, okay? Doesn't have to be straight. You can see if I put the neckline there, it doesn't really line up. It's only one kind of level and price didn't pull back to that zone. So the neckline isn't always going to be straight. Remember, every single chart pattern is different. It's never going to be exact. The shoulders aren't always going to be level. It's going to be a bit deformed. You know, it's never the same. You can't expect chart patterns to look amazing how they do in textbooks. Unfortunately, it's not like that. If it was, well, it would be a little bit or a lot easier. You know, trading isn't that easy. You have to kind of almost paint the picture yourself. So in this instance, the neckline, how I view it, I see it being diagonal. Okay, as you can see here, multiple touch points throughout the market, making it more valuable than that one zone that we just drew on, because we have multiple touch points throughout the market, and as you can see, came back to this level here. Now, these are just pieces of confluence not to enter the market. Okay, guys, I'm not like entering the market or doing anything. I am just getting an understanding of what's going on. Okay, there are some people who would trade this market. There are some swing traders who would be, for example, buying the market at this right shoulder, buying the market up here on the retest of the neckline. That's absolutely fine. They can do that. But for me, I like to go layers deeper. Okay, so once I've established this overall structure on the higher time frame, such as the 1 hour time frame, to see where price is heading, the direction of the market, I then go down to the lower time frames, which is what you saw earlier on in the video on how I actually took the position on the lower time frames. And the reason this was a probable trade was because of the analysis that I'd done on this 1 hour time frame. I knew that price was bullish. I knew that all of these chart patterns were forming. I knew price was going to move up, or the probability that price was going to move up was high. So all I did was then begin looking for these buy positions on the lower time frames. I didn't just go onto the 1 minute time frame and try and find a position. Okay, I used the higher time frames to basically eliminate selling opportunities. Okay, I knew price was bullish, so I was like, I'm not going to look for selling opportunities. I want to be looking for buying opportunities, and when they arise on the lower time frames, I have the higher time frames to back me up. So that was the reason for this buy position, and it looks like this is going to keep going. I don't know what's going on, but yeah, price is really moving right now. So going back to the phases, it happens everywhere. You just have to train your eye to see it, to understand it, to really become fluent at visually seeing it. If I just move my chart, it's like even here, for example, it's literally, it happens all the time. If you just kind of, the more chart time you kind of spend just looking back and really familiarizing yourself with the chart, the more you'll just see it. I don't even need to draw anything onto my charts nowadays to understand what's happening, because I can just visually see it. For example, here we can see that we're uptrending, but look at the impulses and corrections that we're forming. I can say that that's an impulsive move. Look at the bullish candles that are forming, they're very strong. And then look what happens when we pull back. Okay, very small candles, lots of wicks, lots of indecision within the market, and then that just leads to a continuation. Okay, and then again, what happens? We have this pullback. where all the candles down here are very, very small. So on and so forth, we keep going up an inch. It's just identifying not only the trend, because you then you combine it with things like this, you then combine it with price retesting potentially this level down here, didn't pull back there, but you just combine it with multiple different confluences to make the trade stronger. You go down to the lower time frames, you see the structural shifts there. So you don't just trade off phases of the market. You don't just trade off market structure. You don't just trade off chart patterns. You don't just trade off, I don't know what people call it nowadays. I don't even want to say it. I'll probably get it wrong, but all that smart money concept words. It has to all be used in conjunction, okay? But there's a limit, because you don't want to have analysis paralysis where you're just drawing on so much stuff. Still keep it simple, but don't keep it too simple, okay? You have to kind of combine it as much as you can, but not too much, okay? You don't want to overcomplicate things, and yeah, just really keep it simple, guys. But yeah, I hope that was helpful. That's pretty much it for this video. I just want to say I appreciate every single one of you for the support. I know I haven't been as active. I'm going to try and post every single week. I'm going to attach a camera to my chest to film as much as I can. Any trades that I'm taking, I'll film to provide you guys with as much free value as possible. And I hope this video was valuable to you as well. If you're not already subscribed, if you're new to the channel, I would appreciate you hitting the subscribe button, and leave a like and a comment. Let me know your thoughts in the comment section below, because your guys' comments is really what drives me to keep posting, to understand what you like, what you don't like, to keep the content getting better and better for you guys. So yeah, I really appreciate it, guys. I hope you have a great rest of your week, and I'll see you in the next video.